Today we're going to be discussing how to determine your property's value. This presentation is brought to you by James Smith and the James Smith Company. For more information on real estate investing and how to get started, please visit jamessmithseries.com. James Smith, his company, and affiliates are providing this information for general educational purposes only. Before making any decisions regarding tax, business, estate, or financial planning, please consult a respectably licensed professional. Now, when it comes down to valuing your property, there's a couple different indicators or valuation methods that people use. The first one is something referred to as a comparative market analysis. A comparative market analysis is used commonly by real estate agents, and what they're doing is they're taking your property, they're looking at the age, shape, value, condition, and comparing it to similar properties in a nearby area. There's a second valuation strategy. It's referred to as the income approach. The income approach is oftentimes used by real estate investors who are buying cash flow real estate. What that means is they're not so much concerned about a quick buy, fix, and sell. What they're looking for is to hold the property for a long period of time. Therefore, they're interested in the cash flow that's being derived from the property. So they're not going to buy a property based on other values in a neighborhood. They're only going to pay a certain price for the property that allows them to generate a certain amount of profit. So the entire value of the property is being generated off of the income that the property is spitting out. And finally, there's something referred to as the replacement cost approach. The replacement cost approach is used typically by insurance companies in valuing, again, the replacement cost of a structure. Certain times, real estate investors will also use a replacement cost approach if they're buying vacant commercial property that has no income whatsoever. Because if you use the income approach and there's no income, the value would be zero. Therefore, individuals buying vacant commercial property will oftentimes use a replacement cost approach and then discount the value from there. First, let's discuss comparative market analysis. Let's say that you've got a property inside of a neighborhood and you want to sell it. If you're working with a real estate agent, or even if you're selling your own property, what you're going to do is look out in your nearby neighborhood and say, which properties directly compare to mine? How much did they sell for, and when did they sell? If you have properties that sold in your market back in 2005, 2004, and what most people refer to as the hypermarket, those valuations aren't going to be relevant in today's valuation because obviously prices have shifted tremendously. Therefore, when it comes down to comparative market analysis, you're looking for nearby properties that have usually sold within the last 6 months. Now, back in the hypermarket of 2004, 5, and 6, oftentimes a person wouldn't have to look beyond their own local neighborhood to find enough comparative sales. But in today's time, where properties may not be selling as quickly, instead of looking in your neighborhood, you might have to draw a larger radius, let's say a 1-mile radius, in order to get enough comparatives to value your property appropriately. Now, let's say you go a 1-mile radius and there aren't any comps for you to value your property. Well, then you might have to draw a slightly larger radius. Now, when you cast a larger radius, many people recognize that your information or your comparison isn't going to be as strong simply because the further out you get, there's a lot more variables. And the properties that you're basing your property, you're comparing your property to, they may be entirely different neighborhoods or entirely different homeowners associations. There's going to be a lot of factors that can impact it. Ideally, to run a comparative market analysis, you want to find common properties in a local area to your home that's being sold. If you cannot find properties in your neighborhood, then find properties as close to your neighborhood as possible to value your property. Next, let's take a look at the income approach. The income approach commonly is broken down into two main calculations to determine a property's value. Most investors use one or the other. Each of these calculations use different numbers in a cash flow analysis to come up with a property's value. So here we have a gross rent multiplier, which values a property based on the gross rent that's coming in, and there's also something known as the capitalization rate. Capitalization rate values a property based on something known as net operating income. So in a typical cash flow analysis, which you see right here in front of you, where gross minus vacancy plus miscellaneous income equals effective gross, minus operating expenses equals net operating income, you subtract debt service, which is your principal and interest payments, and you get something known as a cash flow before tax figure. Now again, this is a very common cash flow analysis. If an investor is using the gross rent multiplier strategy, what they're looking at is the gross potential income that a property can bring in. Now, one of the benefits of a gross rent multiplier approach is that you can take a vacant property and come up with a valuation by using a gross rent multiplier because the gross potential income, even if there's no income coming off of the property, it's looking at what the property could bring in before vacancy is accounted for. Now, a gross rent multiplier, unfortunately, doesn't calculate anything for expenses or conditions of properties. It doesn't factor that in. So a gross rent multiplier is much more of a rule of thumb. A capitalization rate, what it does is it values the property by multiplying the net operating income by some multiplier. Oftentimes, people are going to want to pay somewhere in the ballpark of less than 10 times the net operating income. So if a property is bringing in, say, $20,000 a year in net operating income, it's ideal if you can buy the property for, say, $200,000 or less. This would be equal to a 10% cap rate. Now, net operating income, as you notice from the schedule here, is a figure that is already accounted for vacancy as well as income and operating expenses. So if you have an older property with a lot of expenses, the net operating income is going to take that into account. Therefore, most investors use a cap rate as opposed to a gross rent multiplier. Finally, there's something known as replacement cost. And replacement cost, very simple. It's simply the land value plus the cost to construct the structure that's on top of the land. It's that simple. For individuals who use a replacement cost approach to value commercial property, what they'll usually do is take the land value, then they'll take the construction cost, and they'll depreciate the construction cost because obviously when a structure is built, the longer it's in place, there's going to be more repairs and be more maintenance. So they'll take the construction cost and they will discount that by 30, 40, 50%. It simply is up to what the market will bear. And so individuals will make offers. If there's a lot of vacancy, they may take the land value and give 20 cents on the dollar for the structural value. It, again, is simply up to what the market will bear. Now let's discuss replacement cost. Replacement cost is very simple. Replacement cost is the land value plus the construction cost to replace a structure on top of the land. It's that simple. For investors who want to use a replacement cost approach, it's advised that when they come up with their formulation, they take the land value, but they don't give full price for the they don't give the full value for the structure on top. The reason why is because once a structure is built, essentially it's depreciating in value because there's more maintenance repairs based on the age of structure. Therefore, investors who do use the replacement cost approach will oftentimes give the full face value for the land, but they'll give a highly discounted offer for the value of the structure on top, say 20 or 30% of what it would cost to replace. This is why in many areas you see individuals going in and buying existing structures as opposed to building new. Building new is oftentimes far more expensive. Building new is oftentimes far more expensive than buying existing vacant commercial space. In today's market of 2009, 10, 2011, it's not uncommon for individuals to see properties going for $20, $30, $40 a square foot, especially when you're looking at commercial properties. Now, this isn't for every area in the United States. Obviously, there are areas that are going to be more expensive, and there are some areas that are less expensive. But if you're building structures at $80 to $150 a foot, obviously depending on the type of structure, you would rather Now let's discuss the replacement cost approach. The replacement cost approach is very simple. In order to determine a property's value based on replacement cost, you simply take the fair market value for the land and you take the square footage of the structure and multiply that by the cost to build that structure on a per square foot basis. So if you're looking at a structure and there's 1,000 square feet and it costs $80 per square foot to build it, then you're going to say that property is worth $80,000. On the structural side, add that to the land and there's your replacement cost approach. This has been a presentation brought to you by the James Smith Series. For more information on real estate investing and how to get started, please visit jamessmithseries.com.